have Shen from Revere and Paola Origel from Chainlink Capital Management. And I'll let them share a little bit more about kind of what they're working on, what they're doing today, and then going to ask some questions from the institutional LP perspective. How do these folks, how do the organizations they're working with approaching, investing in blockchain funds today?
Hi, everyone, and thank you for being here. And thank you, Zach, for having me. This is very interesting and exciting. So, my name is Paola Origel, and I am the co founder and managing principal of Chainlink Capital Management. We are a fund of funds and we invest in blockchain technology.
Hi, everyone. My name is Shen, Houstonian, Longhorn, back 20 years after I graduated, which is insane. Really nice to be in East Austin. It wasn't like this 20 years ago. Thank you, Zach, for having me. I am the co-founder and CEO of Revere VC, which is building essentially the morning star for venture capital in terms of ratings. Zach's fund Unbounded is one of our rated managers, so please come see me for their ratings report. I know Mike Hennessy is already using that for his nefarious purposes. I think today we're really happy to come share some views about what institutional LPs are thinking about blockchain, crypto, and just general technology investing in general. Thanks, Zach.
Yeah, thanks, y'all. And for those of you that recently arrived, the theme of this event is Unbounded Perspectives. So my goal is that every person listening here asks at least one question between now and the end of the day. So I'm going to ask some questions, but there'll be ample time for audience questions for Paola and for Chris. So if you think of something, write it down, and I'll call on you all pretty soon. So to kick things off, Paola, your background's on Wall Street. What attracted you to the crypto and blockchain world?
So, I mean, many different things, but I guess to answer that question, I will try to be brief. A little bit more about my background. I'm originally from Mexico City, and almost by accident, right after college, I was working for Cemex, the second largest concrete and cement company in the world. And I created an e-learning platform for them. Because of that, a company brought me to the US to create and implement similar platforms for retail companies like Target. So I've been fascinated with technology my entire life. I actually knew about the concept of blockchain, many years before actually Bitcoin came up. Obviously, it was the term of like timestamps. So naturally, when I found out about Bitcoin, I was very, very excited, when I read the Satoshi white paper. After I work in technology, I switched to traditional finance and I stay in that industry in New York City for over 15 years. And I was working in traditional hedge funds in the early 2000s, and people were making money left and right. And then in 2008, everything like crumbled down. And for me, I mean, it was terrifying because I was in the middle of it. I was very young. I was in my 20s. And I thought to myself, there must be a better way to do transactions in general, not only finance. So again, going back to when I find out about Bitcoin, it was in 2010, very early actually, and I read the white paper. That was very exciting for me. Now, my story with Bitcoin, as probably many of you in the room, I tried to buy it, but back in the day, you needed to have like a PhD in computer science or be a hacker and go in the dark web, and I was none of that. So I couldn't buy it, but I started following the space. So finally, I went back to technology and I started working in computer programming for one of the computer programmers who I consider like the last geniuses alive, which is Arthur Whitney. He has created 3 different programming languages based on APL, A, KBD, and Q. I don't know if any of you are familiar with those languages. They're very obscure. They're pure math based, and most of the high frequency trading today runs on K. So it's a very powerful language. I worked with him. He hired me to implement his latest programming language on blockchain. So I worked with him for 2.5 years. And during that same period of time, I decided to launch Chainlink Capital Management.
So Chainlink today is a fund of funds that invests in, crypto hedge funds. What made you decide to found the fund of funds rather than be part of one of these funds yourselves and start your own fund?
Well, the short answer is that I don't think I am as smart as some of the people building some of the protocols today. And I say that again because working with Arthur Whitney and being, in touch with that community of like computer programmers, I understood that in order to be able to build a protocol, you need to be highly technical. And I'm not at that level. And when I saw that these people that are geniuses, and I have a lot of respect for them, they didn't even know how to invest or participate in the space, really gave me an indication that the space is very early, that there's a lot of volatility, a lot of high risk, and that most of the protocols or even blockchains that we know today, they're not going to exist tomorrow. I wanted to participate in the space. I wanted to learn and educate myself. And I thought the best way to do that is to have a financial vehicle that exposed me to all the different protocols, including crypto, including different blockchains, and the fund of funds make sense to me.
Any BSV exposure in any of the funds currently?
We do,
Okay,
yes.
great.
That's all you would need to know. I know.
So, Chris, you were also on kind of the fund side of things, fund to fund family offices. How did what made you decide to shift from that to helping these folks make better, decisions?
Well, it's I'm not going to be that person at a conference when you go to like a VC conference and people are saying like, there's that one person on stage with the three-piece suit is like, why should we be investing in VC? I'm not going to be that guy for this conference, but it'll be sort of very apparent that I'm clearly not as technical as some of the very impressive founders that you've brought together today. So after growing up in Texas, I did the unorthodox thing of moving to Asia in 2006. Moved to Beijing, ended up in Hong Kong, and sort of grew up with China, sort of investing and sort of doing advisory work, et cetera. The family office that I co-founded in Hong Kong in 2015 is actually named after West 22nd Street in West Campus. The three of us actually all went to UT. One of us married into a wealthy Chinese billionaire family, not me. From there, my exposure, I think, Paola has some really interesting stories, sort of kind of parallel where I was overseas, but I passed on Animoca when it delisted from the ASX. I know James Ho. I've been to Yatsu's house. They're old friends. I passed Paul Vera did a kid from Pantera is an old friend of mine. It's a fraternity brother. Didn't know what he was doing in 2016. Had no clue, right? So fast forward to today where the experiences of being out in Asia, or it could be any foreign country, and you're looking at sort of innovation, whether that's blockchain, sort of level 2 enterprise SaaS, it could be food tech, et cetera. The United States still holds the baton, so to speak, for a lot of these sectors. And if you don't have access or exposure, or if you're not wealthy enough, like a Utimco or whatever, to get into, say, an Andreessen or a Sequoia or whatever, to have access, how do you sort of, bet on technology, right? You're not buying sort of stocks and sort of worth that. So fast forward today, to that question from that family office experience and having spent a lot of time with endowments, pensions, and sort of all sorts of different people. When you're overseas as an American, you get kind of lonely, so you meet a lot of new people. The Revere essentially is trying to inject a sense of transparency to help investors, whether they're sort of ultra high net worth up to the endowments, pensions, and sovereigns, to essentially get access to emerging managers like Zach that are specialists in what they do, right? There's not going to be another fund focusing on BSV, just like there are certain funds that are not going to do shrimp based sort of all protein and stuff like that. But similar to what you can do when you log on to Robinhood or say Interactive Brokers, you could buy any slice flavor of stocks, bonds, whatever you want. Venture capital is headed that way for sort of the majority of investors.
Yeah, thank you, Chris. So, Paola, over the years and conversations we've had, you've always stressed the importance of operational due diligence. What is operational due diligence and why is it so important?
Well, first, ODD, is very important in every sort of like investment, not only blockchain, but I think it's especially important and critical in blockchain because of what I said before. It's highly volatile. A lot of people want to participate in the space when, quite frankly, they don't have business participating in the space unless you're like highly technical. I don't see why, like Kurt said, like nobody really knows how internet works in the background. You should not even being asking, how blockchain works. So I think, we all know, and especially me coming from traditional finance, going back again to 2008, the collapse of Lehman Brothers, even like what happened with Bernie Madoff, and now like Celsius, BlockFi, and FTX, it's very clear that we need to do our homework. We need to pay attention. We need to have KYC, AML, and a very robust ODD process. And it's great the work that Revere is doing and Chris, because obviously there's a big need of that. So knowing, who you're investing in, the team members, the track record, and not only looking at their background, their shiny bright object, I call it, right? If they went to Ivy League schools, they have the pedigree. That is not enough, and we'll see over and over again. You should not feel FOMO, because I think most of people that lost a lot of money FTX, they knew there was something wrong, but they still invested there and they put their money there because their bodies, they were putting money there and they were making money. So don't be greedy, take your time, be smarter, and do an ODD process and take time to do it.
Yeah. So speaking of FTX, Chris, you're chatting with institutional investors all the time. How would you describe this shift in their mentality and crypto, blockchain broadly since FTX's collapse?
So I'll share some interesting tidbits that probably are not in the news because you've seen ad nauseum sort of what's been going on. So you guys have heard Caroline Ellison, right? Like they lampoon her. There's a profile picture of her with all these trees in the background, right? I think you've seen that picture. You can see my former apartment in the background, Hong Kong. That was taken at Pacific Place, which, if you're familiar with the geography, looks up to the peak and it's all like forest, right? So she was basically taking that in the Pacific Place apartments where a lot of wealthy Hong Kong families live. So I was in Hong Kong about a month and a half ago, and nearly every Hong Kong billionaire family has exposure to FTX. They're not going to say it, but they have it, right? The second point around that is essentially, I would say, if you think about kind of what's going on, fast forward to the Western Hemisphere, OTPP, so one of the large Ontario teachers, and CPPIB, which is probably the most, I would say, sophisticated sovereign wealth fund, or whatever you want to call it, and the Aussies call it superannuation funds, whatever you want to call it. I think they led that round, right, with Andreessen. I don't know, like a couple years ago.
My understanding is the Ontario Teachers Pension Fund was the sole leader of the round.
Sole leader, and then the other CPIB, I think, led Celsius or BlockFi, right? Not to sort of cast aspersions at them, but we were talking to a bunch of Canadian GPs, and they were like, "Holy shit, we couldn't even get on those deals because the larger folks took them." And now the teachers, because Canadians are very polite and nice, are even angrier about why their pension money went to sort of what is now a fraudulent sort of, companies, right? So all this to say, when we speak to a lot of people, I think, Kurt, you mentioned sort of an interesting point about J.P. Morgan, right? J. Pierpont Morgan, the robber barons of the turn of the century. And if you think about CZ and sort of all these other folks, they had sort of their motives, et cetera. But, and I don't want to be that guy at the conference, but when you think about the pools of capital, like CPPIB, Ontario Teachers, Temasek is very active, down south in Singapore, they are a little further ahead, right? They will take the risk. I think they can move on. No one's going to lose their jobs. But if you look at sort of how Chase came to be in terms of acquiring sort of every bank out there, all the large conglomerates, it's because the friends of JP, like the Carnegies and all that, put their money behind them, and they built sort of a colossus through the years, right? So when you think about blockchain and sort of you talk to these endowments and sort of the universities, pensions and stuff, they know Satoshi, they've heard the story. They probably know where BTC is trading on a day-to-day basis because they're trading it themselves. But then they jump forward to like SBF and Caroline, right? And that's their understanding of blockchain and crypto. They've amalgamated that into one sort of thing. And they drag in VC investors too, which is kind of like the VCs are like, what? We can't even get on these deals. Why are we a part of this, right? So when you look at FANG stocks, BTC, late stage growth, anything in blockchain, they trade basically correlated together, right? Up and down with interest rates. So all this to say in a roundabout way is that, when venture capital had this like the 50s, 60s, 70s, 80s, when it was DARPA, Fairfield, and all these people essentially, we need to beat the Soviets, et cetera, the innovation of that. You think about what VC had to do to come mainstream, and it's barely mainstream there yet, not even there yet, right? In some ways, right? But if you think about blockchain as sort of, I heard this analogy that value investing is to venture as venture capital is to blockchain crypto. If you think about that trajectory and where everyone in this room is going, it becomes very, very, very hard for the endowments to swallow it because they're basically still kind of dealing with venture capital as an asset class, right? Not to say it won't happen, but it could be it's really interesting to see how this plays out. And I for one am sort of, observing, sort of being, investing in it, et cetera, et cetera.
Yeah, so I definitely face the fact that the majority of people that consider investing in our fund, at least at kind of the beginning of the pipeline, for them, crypto and blockchain is basically the same thing, which is kind of how we started the day. 99+% of capital that has been invested into crypto and blockchain has gone into crypto assets that are pretty much all glorified Ponzi schemes, or then companies like exchanges, prime brokers, miners that only make money off the speculation of these Ponzi schemes. So I think it's very understandable given that's basically where all the money has gone into to date. That's where, these folks are kind of just combining all of that with, the incredible businesses of some of the entrepreneurs that are speaking today. So of course we know, investors that do make the distinction between crypto and companies leveraging blockchain that is divorced from crypto. How often do you see that distinction on the institutional LP side of things? And can you introduce me to them, please?
Yeah, I I don't want to make light of sort of the losses and sort of all that. I think the sophisticated ones who have how do I say this in a sort of, it's being recorded, right? It the
We
larger
can edit it out.
Yeah, no, it's all good. I'll speak sort of very candidly, and I can take some of these questions afterwards. I think when you spend time with some of these folks, if they're senior enough and they believe the technology, they can then drive sort of institutional change, right? They are directors of private investments and or the CIO running strategy, et cetera, right? But they are also public servants. Like if you think about endowments, a lot of their salaries are published. They are, trading in sort of a certain lifestyle for not sitting on the front lines, working 100-hour weeks, all that kind of thing, right? So they're investing to save their jobs. I think the fallout from, and a lot of these folks invested in Andreessen crypto, which, when we talked to the people there and the companies they invested in, there was a mismanagement of sort of when those tokens hit, it wasn't properly managed, is what I hear, right? You can check with your friends on that, et cetera. Same goes for a lot of these mega funds where if you're raising $2 billion to invest in crypto projects, I don't think there's enough sort of stuff going on in that market to make sure that gets put to work in the next 2 years, right? Just it's a figment of the markets and sort of what's going on. So when you look at these sort of forward thinking endowments and pensions and sovereigns, they are looking at that. But then I tell a lot of the emerging managers. So we work with over 250 emerging managers in counting, right?
What is an emerging manager?
Emerging manager is basically anyone who's not Sequoia, Andreessen, Benchmark, Lightspeed, right? Not a sort of a pejorative in a sense to funds like yours, but essentially sub 100 million. It could be a fund 1, 2, 3, 4, whatever, but they're not nationally known brands, right? Or internationally known brands, right? In Europe, you got Excel, Index, maybe Atomico, Balderton. In Asia, it's like some of the Chinese funds, right? Like Sequoia China, et cetera, et cetera. But everyone else is basically an emerging manager in our book. So we rate, work with them, counsel them, bulletproof their fundraising, et cetera, et cetera. So when you look at sort of the emerging managers, going back to Zach's question on the endowments, it comes back to something that all of us founders always think about, right? Product market fit. If you're raising $50 and the minimum check size of an endowment is $50, and they have a holding limit and concentration sort of parameters, they can't even talk to you, right? You have to log it, talk about it, et cetera, right? So the problem with a lot of these endowments is that they're too big for their own good, one. If they go through sort of an emerging manager program, which either has a DE&I lens or not, or whatever, CalPERS came out with something that is strictly focused on, doesn't matter what your background is, we're going to invest in you if you're a fund one across credit, VC, whatever, then there's some sort of hope in terms of getting into those, getting those networks. But a lot of those folks then sort of make the same mistake around pattern recognition and essentially go after spinouts, right? You have to have that pedigree, you got to wear the Patagonia vest, et cetera, and kind of go from there. So it's not a problem that I can sort of wave a wand and sort of solve it. It is something that's improving with time. And it's kind of mirrored in the ethos of why Paula and I invest in emerging managers as opposed to chasing Andreessen sort of gaming fund, Sequoia 55 or something like that.
So you've looked at a lot of the data out there for how different venture capital firms perform, probably more than almost anyone, and you have a lot of your own proprietary data. For folks here to understand, how do emerging funds, these smaller, less brand name known funds, perform against some of the bigger funds? And is there any difference in what you see broadly in venture in crypto and blockchain?
Good question. I would say so. We've got about 250 funds and growing. We have sort of the overlay with PitchBook, which is about 30% inaccurate. The other companies are even worse. So when you look back to a 2019 vintage, when these managers come to us, if you take a sample size of 20 to 25 funds, a 7x is probably around top decile given the markups in the market, not a 5x, right? We had managers that come to us and ask about that. But the Cambridge Associates of the world, and Paula and I were talking about this just a minute ago, there's a survivorship bias in that Cambridge Associates services endowments billion and up. They want, goes back to that product market fit issue. So the managers that go through their gauntlet, there's like three that make it through to get like that money from the Gettys or the Harvards or whatever, right? So if you're evaluating those funds and you're looking at emerging manager data, it is skewed with survivorship bias and sort of those managers outperforming because there's also a curve and a distribution, right? So within sort of that, the immediate answer to your question is that the blockchain crypto funds right now are licking their wounds simply because of mismanagement and or sort of investing in too concentrated bets during the top of the market, right? We're going to wait to see how that plays out because we don't want to hold them against sort of the mania that's happened in the last 3 years. The VC funds, however, that are not sort of super concentrated in blockchain have done better, obviously with sort of interest rates where they were and sort of the tech push. But again, those were, a lot of that got marked down recently, and we'll see sort of how that comes out now. So generally speaking, going back to that point on Cambridge, they have a 2019 study, which is ancient by now, that shows that the funds that Paula invests in, fund one, fund two, sub 50 million, are always going to outperform basically the Excels, the indexes that are basically writing growth equity / buyout style checks. Full stop, right? It's always going to be like that. It's a numbers game. And that's why you see Andreessen and Sequoia changing their models or going into the RIA and investment banking business or even the HR business, right? Because they can, right? They have the brand. So our data, I'm happy to share and talk more about that separately, but that data is a service model where you want to see sort of certain sectors, geographies, et cetera. We have things that are, pretty much going to help you make certain decisions about sectors you may or may not have known in emerging managers.
Well, thank you, Chris. So on my end, I got a couple questions for you both to close us out. And feel free to be very brief during this. What do you think the most overhyped sector in crypto and blockchain is?
I think that's a great question because I think I would like to start by defining what sector is right in the space. And I think if you haven't seen, the classification that Morgan Stanley created under the website MSCI, it's a very interesting structure of the ecosystem. And the way they divide it, they have classes first, and then they have sector and subsector. And the classes are divided in four, which is the digital currencies, blockchain infrastructure, digital asset applications, and the on-chain coins derivatives. So, and then the sector, which is, I'm going to your original question, is not necessarily what we think about. For example, a sector will be metaverse, but the subsector will be NFTs, gaming, and so forth. So most people are actually, the hype comes from the subsector, not the actual sector. So I will say, for me now, and going back to that classification, it was very interesting to me to see because I think the new hype is going to be AI with blockchain, because I think both combined are going to be very powerful, but it's not there yet, which I thought it was like kind of crazy. And I'm interested to know what you think about it, when you see it.
Like a lot of things, I think there's some really cool things happening that is there, but the vast majority is not. So yeah. Like anything that's overhyped, there's a reason why it's hyped.
Yeah, and I want to add to that point. Nothing to add, nothing to supplement. I completely agree with Paula. But when you start, so we don't traffic in secondaries like the SPVs and all that, because before it was Quiso and then went to SpaceX and then became ByteDance. And now everyone has been knocking on their door asking about OpenAI, right? So that's when you know if they're willing to pay a 5% upfront with like 30% carry on SPV that barely gets you 2 layers onto the cap table. Run like hell. Run away. Just run away. Please run away.
So kind of the converse, what do you think are the best investment opportunities in digital assets, blockchain, crypto today?
Okay, so I'll say I'm gonna try to pitch my phonophores, of course. So I think more than like investment opportunities in sector, I think for investment strategies, I still believe in the space is fund of funds and early stage venture. Like your fund. For investments opportunities, I will say that it depends on the profile of the investor, and why you want to participate in the space. So if you want to make like quick money, then it's a different horizon. But if you actually care about the infrastructure like you do, I will tell people look really into the infrastructure and the new blockchain and the actual technology. That's what I will put my money. And it's a long-term, investment, but I think it's going to be the most valuable long-term.
Yeah, I would add to that. It comes down to risk tolerance, right? We talked about endowments, sort of the more sort of risk adverse ones, the ones that have plenty of money and sort of their students are going to school for free and they're okay with that, et cetera, et cetera. But if you're an individual family or a family office and you're looking at 20, 30 years, go with the fund of funds, right? There's no sort of, to be blunt, like there's almost like this shame of fund of funds, I think post GFC, where a lot of the hedge fund of funds got wiped out, right? And then people will be like, oh, 2 layers of fees, whatever. But you are paying an expert that knows what they're doing to drive returns. It doesn't mean that you can't do in co-investments, because you can go to the fund of funds manager and say, can you please set up a dedicated co-investment product for me? And I just want to, that's my exposure, right? Learn. There's no better way to learn about a new sector than by doing, you can start a company, which, as a founder, I highly advise against. But just, and all the founders are like, yeah, man, we're in this together. But if you're an investor, just focus on learning. There's no better than just learning and doing. So within Revere, the plug, not a plug, but just the FYI is that we build custom fund of funds. So we can be helpful if you don't find what you want, right? So one of the funds or funds in general. So one of the funds that we invest in, to Zach's question, is an infrastructure fund around blockchain, right? We had a inbound from a Thai family that brought in about $10 million. We've made about 25 investments already. But it goes back to the adage that there's no better substitute to learn than just by doing, right? Invest, learn, make mistakes, et cetera.
So when you say you made 25 investments, are those into 25 funds or into some companies, some funds?
Good question. So it's a barbell approach. Like we have funds on one end. So we invested in folks like Orange DAO, Awesome People Ventures. We've looked at all the big names. And then on the other end, we'll take early stage pre-seed seed bets on things where I come from more of a consumer sort of fintech background. So we'll apply sort of that lens. And Paula, we're talking about the technology. We have to outsource some of the tech because we can't do it ourselves. We'll go to sort of advisors, but we apply that lens to invest in direct companies early on. Just because, again, it goes back to the adage, you have to make these mistakes, do it, learn it, et cetera, et cetera.
Cool. Well, thanks, y'all. Looks like we have about 7-8 minutes now for some audience questions. Get some microphone support. Thank you. And any questions, anyone, for Chris, Paola? Okay, Kurt.
Hey, really, really great information, actually. My question is how do you weed out bad information? Because I feel like I know a lot of crypto blockchain. I live in Miami, so it's yeah, literally you sit down at the bar and
no one really works there, right? Like no one works there. It's like literally it's so chill there.
Right. It's
like
brunch, so nice. Drinks, nap time,
yacht party,
nightclub.
Boat,
yeah, right. Time to go to the beach. So, but everybody's also a blockchain startup founder. Literally everyone. And so, but the information is so bad. I mean, we've even seen it. The biggest product to come out of the Miami area was Solana over the last couple of years. And it can do all this stuff. And then it comes to Solana was down for 48 hours straight in the last 10 days. People don't even know this now, but it literally doesn't work, but it raised billions of dollars and all this stuff. How do you filter out these people that say, hey, our blockchain works and here's why? And how do you get past all of that? I feel like it's so dense with bad information that how do you even get through it?
As I said before, you just need to take your time and conduct like ODD on them, but not only operational, that's what we discussed before, because it's blockchain, it needs to be technical at the technical level. So if you are an investor, you should always have a person in your team who is highly technical if you want to invest in this space and understand what the actual smart contract is saying and really looking at the gaps, especially with blockchains like Solana. And I talk about this all the time. The best programming languages are full stack, and that's full stop. And when people start talking about like stacking different programming languages, something's going to break, especially when you scale. It's impossible. Again, going back to high frequency trading, we're talking about petabytes of data in nanoseconds. There's no blockchain that can handle that. So do due diligence and rely on technical people. If you see a team that lacks technical ability, I will walk away.
Don't go to Miami. Invest in her. Right? Simple as that. Move on.
Killer. Thank you.
Sam?
Yes. Hey, thanks, guys. Great talk, by the way. I really enjoyed it. Just a question for both of you guys. What's the number one characteristic that you're looking for when you're evaluating a company to invest in or an emerging manager to back?
Well, I will agree with Zach. If you're not solving a problem and you're not making the world a better place with that, don't touch it, because what's the point? If we're going to repeat, like the same mistakes that we had outside blockchain, then what's the purpose of using blockchain technology?
Yeah, I would add for emerging managers specifically, and this is global, right? It could be here, not Miami, Asia, LATAM, et cetera. Their investors sort of, I guess you can say, have different, obviously we talked about risk tolerance, but preferences, right? There's certain people that, I was one of them. I wanted to punt performance on the fund level because I wanted the co-investments and the education to buy into that network, because it would accelerate sort of, instead of me flying back and forth for 3 or 4 years out of Hong Kong, I could just buy into that network and understand like the LA ecosystem, right? Through a manager. So there are people like that, right? On the other end of the spectrum, but then when you evaluate those managers, they have to be like, not a dig at engineers, but engineering types who do not want to open up their network and or sort of be social, versus the types who are, can get out there, introduce you to people, et cetera. So I think when you look back, and I'm happy to talk about this offline, when you look back at sort of most investors will purely go after what can drive returns. But when you break it down into sort of the 20 different metrics that we look at, it is essentially, what is your flavor? Like, do you want LP co-investments? Do you care more about the pedigree that they went IV and sort of did this and that? Are you looking for angel operators? Are you looking for spinouts, right? Because all these different things factor into, because of the breadth and diversity of emerging managers, you can literally pick the type of manager to be your sort of guide into that sector with the personalities, the background, the pedigree, whatever that fits you, that you're comfortable with.
And I will add to that, for emerging managers, especially in this space, I will encourage you to invest in managers that have a track record, that have gone, through the crypto winters, that understand what they're doing. Because I always say 2021, everyone was a genius. There's so many emerging, managers that they just appeared during that year. I want to see the numbers before 2021 and after. I want to see what they're doing today and after and before. So I will look at that as well.
Thank you, Sam. Any other questions here for our panelists? Okay, one last call. Okay. Oh, okay. Suresh?
Hey, okay. I've been in fintech. So as you talk about due diligence and compliance, as capital allocators, how do you kind of look at the regulatory landscape today where there is a lot of, if you go ask a bank compliance manager or compliance director, we want to explore blockchains and how they can improve our partnerships and our institution. And they say, this doesn't look like it violates any lines, but we don't know anything about blockchain or smart contracts. And meanwhile, the the Fed and the regulators are extremely slow to put out explicit regulations. So everyone's kind of shrugging their shoulders, wondering, what's the degree to which we should experiment institutionally when we go partner with startups. And as you kind of like advise your companies and decide who to allocate to, I'm curious in your due diligence how much that comes into play when you're looking at, especially like the fintech institutional side of blockchain applications and POCs.
Well, I think that will apply more, for direct investments. Again, that's one of the reasons why I run a fund of funds, right? Because I do have to rely on the more technical managers that I invest in to do that. And the due diligence that I have, I also create a very robust ODD process, but it's not at a technical level because that's not what we do. And I recognize that I do not have the talent to do that.
To add to Paula's point, we think about that. We rely on the manager one, but then when we invest directly, we want to look at use cases where if this door closes because Gary Gensler is sort of on a power trip this week, that type of thing, or if other jurisdictions, I think another one of your companies that presented was looking at Nigeria, Vietnam, and some other countries, and the consumer laws in each of those places are very, very different, right? So my reliance on the manager to spot that issue and then to tell that company, hey, you got to look for these certain things is sort of a baseline check or sanity check that I would expect from that GP. So.
Cool, thank you. Probably got time for one or two more questions here. Another for Kurt over here. Curiosity is good. We like curiosity here.
So another thing, when I think of VC and value investment and endowments and, like the longer and longer term on how long your money needs to sit somewhere and accrue extra value or absorb extra value from productivity. And then I think about what that looks like in crypto. I've been in Bitcoin for like 10 years now, and I can think of maybe half a dozen things that have ever lasted more than 2 or 3 years before completely going away. And this is at the blockchain level or the app level or any business. Like there's very few companies that have grown past their initial cycle. So how the heck do you even begin to look at the 10-year scope on something? Like what performance data can you even show actually for, hey, we bought anything 5 years ago that is worth more today, other than maybe just holding the Bitcoin basket or maybe in a bit like a company like Bitmain or something. But what does that even look like? It just occurred to me that I can't even picture what it could look like.
Well, in my case, I invest in like early stage venture funds, but they're not long term, to your point. So the investment cycles or periods are between 3 to 5 years top because we don't have the data and we don't have the track record.
Okay.
Yeah, same point. I think when you look at sort of the fund terms, right, you have sort of the fund life, the investment period, and sort of those are not sort of the same thing, right? Like you've seen sort of all those terms, et cetera. So to Paola's point, that's really important because these are shorter life cycle funds. The endowments pensions are looking at it that way. I think there's going to be a drying out of that money as sort of this sector licks its wounds. I think the JP Morgans of the world, et cetera, while they talk a big game about Bitcoin, very different obviously from the technology, their teams, I can confirm, are all sort of implementing blockchain technologies into their operations to streamline because they, for lack of a better word, want to streamline their workforces, right? Full stop. So that's still going on. So that longer term sort of runs kind of weirdly in parallel with shorter fund lives. So hopefully those technologies can make that leap so that, fintech, to, Suresh's point about fintech sort of players can kind of go on that highway that we saw sort of with traditional fintech implementation around payments, microfinance, et cetera, et cetera.